This is the video lecture on acquiring plant assets. Now, in many different lectures and other accounting courses that you've taken in the past, you've learned about the plant assets. And these are assets like equipment, buildings, machinery, long-term assets that are going to be used in the business. But what we're going to talk about in this particular lecture are all the different ways that we can actually acquire those assets. And as a result, the different accounting mechanisms and different rules that we're going to have for those different situations. So if we're going to acquire a plant asset, there are essentially three different possible ways to do so. The most obvious would be to simply purchase a plant asset. That's very common. But it's also possible to have what we call self-constructed assets, and these are assets that we build ourselves. Or it's possible to exchange an asset or to have a trade. So we might purchase the asset, we might build it ourselves, or we might trade for it. Those are really the three possibilities. So we need to talk about all the different accounting rules about how each one of these circumstances would potentially be treated. So when it comes to purchasing, the main thing that you want to remember is that any plant asset that I purchase, I want all of that to be capitalized because that's going to be depreciated. And when I record that plant asset, remember that the cost includes all costs. It's all the costs that are necessary to not only acquire that asset, but to also get it ready for its intended use. So depending on what it is that you're purchasing, in addition to the actual asset itself, it could include shipping, it could include permits, installation costs, legal fees, all the costs that were necessary for you to get that asset and get it ready to be used. All of those costs have to be added together in the total cost when you're purchasing a plant asset. So to see this in an example, this company is going to purchase equipment. The actual equipment itself costs $100,000. But we also will pay $6,000 just for the shipping, $10,000 just for the installation, and another $2,500 for special permits that give us permission to operate this type of equipment. So how would this be recorded? Well, believe it or not, we would not account for all these things separately. They would all be added together. So all those amounts would be added together, and you get from that $118,500. We debit the asset, equipment, and we credit cash for the total. Why am I lumping all that together? Because all those costs were necessary to not only obtain that equipment, but to get it ready for its use. So that all needs to be capitalized over the lifespan of the equipment. So that's the main thing to remember when you're purchasing. All necessary costs must be included in the asset. Now, in addition to purchasing, it's also possible from time to time that we might actually construct our own plant asset. So we could build our own building, we could assemble our own equipment. Many times we will do that. Now, there's going to be lots of costs that are included. The cost of the materials, the cost of the labor, the cost of the permission and the permits, all those things are pretty obvious costs. And obviously, all of those would be added in. So really the only questionable part of it has to do with interest. Now, if we're going to construct our own asset, like I said, materials, labor, that's obvious. But the interest part of it is a little less obvious. What are we going to do to account for the interest? Well, maybe we don't have to do anything. In some cases, some businesses have so much money that they're able to self-finance the construction. And if that's the case, they will have no interest. But if they do not have enough money to finance it themselves, then they're going to have to raise that money. And if they're going to raise that money, chances are it's going to be through bonds and things of that nature. So as a result, there will be a certain amount of interest expense. So the question arises, how do I treat that interest? Should I go ahead and expense the interest, or should I capitalize that? So that's where we get into this sort of expense versus capitalization argument. Now, one possibility would be to go the route of expense. If I can go ahead and expense something, then I'm just expensing it immediately. It's going to go ahead and be recorded as a debit to an expense account. And by doing that, I'm going to get an immediate tax benefit because all expenses reduce my profit. And the less profit I make, the less taxes I have to pay. So that's the way that works. But if we're going to capitalize a cost, that means we're actually going to expense it slowly through depreciation. So that means we don't get the same immediate tax benefit. And that also means that that cost is going to be lumped in with the asset itself rather than put to an expense account. So those are the two possible treatments of the interest. So the real question then is, what does GAAP say about it? On a self-constructed asset, what does GAAP say about the interest that we incur? Well, here's what they say about it. We have to capitalize the lower of either avoidable interest or actual interest. So what that means for us is we have to learn how to calculate the actual interest, we have to learn how to calculate the avoidable interest, and then we'll compare the two, and whichever one is lower, that's what we will have to capitalize. The rest of it can be expensed. Now, the actual interest, that's going to be pretty easy to calculate. It's based on the simple interest formula. Interest equals P times R times T, principal times rate times time. And you've calculated that many times by this point if you've made it all the way to intermediate accounting. So that's a pretty easy calculation to work with. But that will calculate the simple interest on all the debts. You add it all together, and that gives you actual interest. So that's actually pretty easy to calculate. The avoidable interest, that's a different story. Avoidable interest is a little bit more difficult because you have to first identify what we call construction-specific debt. And those were the debts that were borrowed literally to finance the construction. But then any other debts that you might have to be averaged. And then you average that to get an average rate and an average expenditure. And then that's added together to get the avoidable interest. So that's a little tougher to calculate. And in fact, in another video, we're going to actually work a problem, a demo problem, where we focus exactly on how to do those calculations. But that's what GAAP says about interest and how it is handled on self-construction of assets. Then once we calculate that, then we can actually do the journal entries. And there'll be a whole series of entries that we'll have to do to show the cost of the construction and what amounts are going to be capitalized. Now, the third and final possibility is that we might obtain a plant asset through exchange. That means that we're going to exchange or trade one asset for another. Every time we do that, that's going to require us to do a journal entry. And usually, as the result of a transaction like that, there will either be a gain or a loss. Now, in order to handle these types of entries, there are going to be certain rules. And if you know these rules, it's going to be very helpful and make it a lot easier for you to record these types of entries. So the first rule is that losses are a debit, gains are a credit. That's very important to know. And in fact, the nice thing about that is there's going to be many different situations in accounting in which we could potentially have losses or gains. It's true for investments, it's true for foreign currency transactions, it's true for exchange of assets. Many different things will lead to this, but the nice thing about it is losses are always a debit, gains are always a credit. It's very predictable. So that's the pattern that you always see there. The other rule is we always have to remove the old asset with a credit and record the new asset with a debit. That's another pattern that you always see. Then another rule, we always have to eliminate the accumulated depreciation, because remember, accumulated depreciation is a contra asset. Well, if I no longer have the asset itself, I've got to remove the contra asset. So that's done with a debit. And then finally, any cash involved. If I receive any cash, that'll be a debit. If I pay any cash, that's a credit. So those are the rules. Losses are a debit, gains are a credit. We got to get rid of the old asset and record the new one. We got to get rid of the accumulated depreciation, and any cash received is a debit, any cash paid is a credit. So those are the patterns and rules that you always see in these types of entries. So to see an example of an asset exchange, we've got a business here that has decided to trade their old equipment for a new vehicle. Now, the old equipment had cost $50,000. They've been depreciating it for quite a while, and the accumulated depreciation is $45,000. The old equipment has a fair value of $6,000 and a book value of $5,000. Now, where is that book value coming from? Well, think about it. It cost $50,000. We've depreciated it $45,000, so 50 minus 45, it's got a $5,000 current book value. The new vehicle is going to sell for $20,000, and they're going to give us a trade-in allowance of $9,000. Well, notice how that exceeds the fair value. Remember that. That's going to come in handy on this journal entry. So here's the journal entry that is required. Now, what I have to do with a journal entry like this, I have to record the new asset, and I have to get rid of the old asset. Well, the new asset is the vehicle, so I'll debit vehicle. The old asset is the equipment, so I credit equipment. Now, remember we said assets are recorded at historical cost. The equipment was $50,000, so I will credit equipment for $50,000 to remove that from the books. I also have to remove the contra asset. It is accumulated depreciation, $45,000. I eliminate that with a debit. Then I'm going to have to pay a certain amount. Now, why am I having to pay $11,000? Well, think about it. If you go back and look at the information, it says the new vehicle sells for $20,000. They're giving us a trade-in allowance of $9,000. So they're going to knock $9,000 off the price. So that's why I have to pay $11,000. And then I have to show the gain involved, which is a gain of $1,000. The fair value right now is more than the book value, and it exceeds it by $1,000. So remember, losses are a debit, gains are a credit. Well, the gain goes on the credit side. And then the final piece of the puzzle is this value of $17,000 that I place on the vehicle. And basically that just comes from the balancing of the journal entry, because I've got $62,000 over here and I need $62,000 over here to balance it out. So that's the reason why we have to do it that way. But that is a classic example of an asset exchange. That's just one of the 3 different ways that you can acquire a plant asset.